If you earn over $150,000 and someone told you that you make too much for a Roth IRA, that's not the whole truth. And every year you accept that answer, you're handing the IRS tax-free growth your family will never get back. We've spent decades sitting across the table from high earners in exactly your spot, watching this one go unaddressed.
This video is for educational purposes only. Always consult professionals before making legal, tax, and investment decisions. One of the biggest misconceptions in retirement planning is this: I make too much money for a Roth IRA. And in the strictest sense, you might. There are income limits on direct Roth contributions. But here's what most high earners are never told. There's a second door. It's called a backdoor Roth IRA. It's not a loophole. It's not aggressive. It's actually IRS recognized as a technique that executives, physicians, business owners, and dual income couples use each and every year.
Some of the wealthiest families we work with do this every single January. We keep a list, same families every year, because every dollar we get into a tax-free account is a dollar the government can never touch again. And here's our thinking on why that matters more than most people realize. We believe that taxes are on sale right now. We're running record deficits and record government debt. And at some point, we think taxes are likely to go up. So the more money you move into accounts that are tax-free for your lifetime and your children's, the more control you keep over a future nobody can predict. But first, why are tax-free withdrawals in retirement worth all this trouble? Because this isn't really about one Roth account. It's about your lifetime income tax bill. So start with tax-free growth and then money compounding tax-free for decades. It's enormous. You take dollars that would otherwise throw off taxable dividends and taxable capital gains every year, and you move them somewhere none of that matters anymore.
Second, Roth IRAs have no required minimum distributions. Your traditional IRA, the government tells you when to pull money out and how much, whether you need it or not. A Roth just keeps compounding until you decide you need it, or it becomes one of the most powerful estate planning tools you can hand to your kids.
And you can use it like a scalpel. If you need income in retirement, but pulling from a traditional IRA would shove you in a higher tax bracket, or, say, trigger Medicare surcharges, you could pull from the Roth instead. No tax hit, no bracket creep, no surprise letter. Then there's what we call the someday single scenario. If you're married, picture the day one of you is on your own, because the survivor doesn't just lose a partner. You lose half your tax brackets. The income stays about the same, but the tax bill can nearly double. Having tax-free dollars ready for that day isn't just helpful, it's protection.
So here's how the backdoor Roth actually works. And it's simpler than you expect. No matter what you earn, whether it's $100,000 or $10 million, you're eligible to make an IRA contribution. You just may not be able to deduct it. So we make a non-deductible contribution, meaning after-tax dollars into a traditional IRA, and then we convert it to a Roth immediately.
That's the move. You contribute one day, and you convert it the next. Now it's in your Roth, tax-free for a long, long time. And because you convert it right away, there's almost no taxable gain, maybe a couple dollars of interest between Tuesday and Wednesday, but that's it.
Hence the name, backdoor. You're not walking through the front door, which is the direct contribution you're phased out of. You're taking a small detour through a traditional IRA and walking it right into the Roth. This isn't secretive. Every time Congress talks about rewriting the tax code, the backdoor Roth comes up, and every time they leave it open. It's a legitimate, recognized planning tool.
Now, timing matters because good tax planning is about precision. In a perfect world, you would contribute on a Tuesday and convert on a Wednesday. Bang, bang. No buildup in the traditional IRA, so every bit of growth happens inside the Roth, where it's tax-free. And here's the part people forget. You have to do both steps. We've watched people do one step and then, well, forget step two. Now they've got after-tax money sitting in a non-deductible IRA doing nothing special. Contribute, convert, done. Then we do it again next year. It's that simple. If this is the kind of thing your current advisor has never once walked you through, you're in the right place. This channel shares the conversations that usually happen behind a closed door out in the open. Subscribe and you won't miss what's coming.
So this is the number one reason you don't want to try this alone without seeing your full picture. It's called the pro rata rule. If you already have traditional IRAs with pre-tax money in them, the IRS won't let you cherry pick which dollars you convert. They look at all your IRA balances together.
So say you've got $1 million in a traditional IRA and you put $8,600 of after-tax money in your backdoor Roth. You can't just convert the $8,600. The IRS calculates the ratio of after-tax to pre-tax across every IRA you own and taxes you on that basis.
What that means is most of the $8,600 conversion becomes taxable. You put in after-tax money and you pay tax on it again. Not what you signed up for.
But the pro rata rule is not a death sentence. It's actually a planning opportunity. Couples come to us all the time, both working, both high earners. The husband had millions in his traditional IRA, so a clean backdoor Roth IRA wasn't in the cards for him. But say the wife's IRA was only $150,000. So we started doing backdoor Roths for her every year, documenting the basis carefully year after year, knowing that when the day came to convert her whole IRA, she'd get credit for every after-tax dollar we've tracked along the way. The rule that blocks the do-it-yourselfer becomes an advantage when somebody's actually watching it.
So here's the low-hanging fruit. If you don't have any traditional IRAs, maybe everything's in a 401k, you're the perfect candidate. No pro rata issue at all. We do those all day long. Also, inherited IRAs don't count. 403Bs don't count. It's only your traditional IRAs that create the complication. So before you assume you can't do this, the answer depends entirely on your specific situation. We'll be straight with you. This isn't magic and it doesn't fit everyone. If you've already got large traditional IRA balances and no plan to clear them, a clean backdoor Roth IRA barely works, and forcing it is a waste of your time. But if your retirement money is sitting in a 401k or your IRA is small, the door is wide open, and it costs you every year you leave it shut.
Now, here's a mistake we see more often than you think. When you do a backdoor Roth, there's a form, IRS Form 8606, that tracks the basis in your IRA, or what we call the after-tax dollars. It tells the IRS, this money was already taxed, don't tax it again. And we've seen people do it right, and then their accountant reports it as a taxable distribution. So they pay income tax on the money they already pay tax on, right? The only thing worse than high taxes is paying taxes on a dollar more than once.
And it gets worse when people move states. In our state, Pennsylvania, you pay state income tax on the money going in and nothing when it comes out. But move to New Jersey, New York, Delaware, Maryland, Virginia, the Carolinas, the rules change. And if that Form 8606 isn't filed right, you can end up paying state tax twice on the same dollars.
This is the reason we follow up on every client's tax return to make sure it's handled properly. This is the kind of error that hides for years, and by the time it surfaces, the money's gone, and it may never surface. We sat with an accountant once, decades of experience. In fact, it was his final tax season before he was retiring. We were converting a client's IRA to Roth, and he looked at us and asked, why are you doing that? We said, well, one, we think taxes are going up. We think taxes are on sale. But two, what happens when one of the spouses die and say the wife is a single taxpayer with these massive required distributions? I thought his answer was strange. He said, I never thought of that. That's decades of experience. And that question had never come up. I couldn't believe it. That's the gap that coordinated planning fills. And here's the move almost nobody makes. There's an exemption for a non-working spouse. Both of us have wives who don't work outside the home. So we do backdoor Roth IRAs for them each and every year. It's a whole second contribution. It's the same tax-free growth for a spouse with no earned income of their own. Most households never claim it. There's tax-free room in your family is leaving on the table every single year. Nobody sets it up.
So here's where this all connects. The backdoor Roth isn't really about a few $1,000s a year. It's about tax diversification, having pre-tax, after-tax, and tax-free buckets in retirement. So you choose where each dollar of income comes from, because life creates surprises. The HVAC system dies, it costs you $15,000. The windows need replacing, it can be as much as $30,000. If the only place you have money is a traditional IRA, every dollar you pull out lands on your tax return, pushing you into a higher bracket, maybe trips Medicare surcharges. With diversified buckets, we pull from across them all and make the whole problem smaller.
And from a legacy standpoint, a Roth is tax-free for your lifetime and then tax-free for your beneficiaries for up to 10 years, provided the beneficiary designations are done properly. That's one of the best wealth transfer tools there is. Compare that to a traditional IRA, which was really built to be spent during owners' lifetimes, not handed to the kids and grandkids. So the question for your family isn't whether Roth strategies matter, it's whether they're being implemented thoroughly and coordinated with everything else.
Because it's never just the Roth. It's how the Roth fits your 401k strategy, your estate plan, your income needs, and your lifetime tax picture. The most valuable moves happen between the lines of investments, taxes, and planning, not looked at one at a time, looked at as a unit.
So now you know the door most high earners are told is closed and how to walk through it without paying tax twice on the way. But the backdoor Roth is one tile. Here's the question that should keep you up at night. Are you even measuring the right number? Most families obsess over this April's tax bill and never see the bigger one, the total their family will pay over an entire lifetime, what we call your lifetime income tax bill. And that number is almost always larger than they think, sometimes by hundreds of thousands of dollars. Your refund tells you almost nothing about it. Here's a video that shows you why this year's tax refund is the wrong scorecard entirely, and what the informed measure is instead to shrink that lifetime number. Watch it now, because investing is the easy part.